of Better Investing. I'm going to turn this roundtable program over to my friend and colleague, Mr. Mark Robertson. Mark, go ahead.
Thanks, Ken. Let's go ahead and get underway. Welcome, everybody, to the September session of the roundtable. We're having a little bit of fun with a few good horses this month, and we do have a special guest, our guest damsel, Susan Michelik from Wisconsin. And Susan is a ringleader in a very successful investment club over there, and we're very happy to have Susan join us. She's been a guest damsel several times in the past, and look forward to her presentation. Cy Lynch is also joining us this month. He doesn't always get in with us with his schoolwork and everything these days, but again, welcome back, Cy, and we look forward to hearing from you.
Thank you, Mark. Glad to be here.
For those of you that don't know Ken is, again, a ringleader up in the upper parts of Michigan and a presenter at a number of national programs. And between Ken and I, in fact, all four of us, we've all been active in investment clubs for literally decades now, and just want to share some of those experiences with you. For the record, the gentleman riding the rhino in the upper right-hand corner is not Hugh McManus. Hugh is in Switzerland tonight, unable to join us. He said he might try to drop in on us, but the time change is quite a challenge. Down towards the bottom of the page, you can see that there is an email address there if you want to be added to an email list for session reminders, nkabula1@comcast.net. Again, I am picking up a little bit of key punch noise, so you might want to deal with that. Any other questions, you can feel free to email me at markr@manifestinvesting.com. Let's go ahead and get underway here. Get the other stuff out of the way. Everything that we do here tonight is for demonstration purposes. It's to demonstrate a philosophy and show how some of the processes and analysis techniques of principally of the modern investment club movement are put to use. Everything here is for purposes of demonstration. No investment recommendation is intended. All right, here's our standing agenda. And again, we pretty much go through this the same way. We've been doing this for over 4 years now. If you're new to this, welcome. This is the type of program that we typically put on. And if you're returning, extra big hug for you too. Hopefully that your autumn is greeting you well. But we'll start with just a few looks at the portfolio, kind of a look at results. Don't really have a challenge stock for tonight. Don't have a holding that's really on the hot seat. I think we might tackle that in a little bit more earnest here in the next couple of months. Then we'll launch into our selections. Susan's going to present CaesarStone. Ken is going to bring us Cyberonics. Cy is coming back with Priceline. And I'm going to close things out with Atwood Oceanics. And we'll have an audience poll at the end. So let's go ahead and just remind ourselves what we're doing here. This is our demonstration. We really do kind of sift through our recent studies and screening results, that type of stuff, looking for a single favorite investment opportunity to bring to these sessions. We do keep track of them in a tracking portfolio we'll look at in a second. Our goal is for that long-term tracking portfolio to outperform the general stock market as measured by the Wilshire 5000 by 5 percentage points over the long term. We're not there yet, but we can. That is our goal. We'd also like to see 3 out of every 5, maybe a little bit more than 3 out of every 5, outperform the market. We have seen many people achieve that, and it's actually quite an ambitious goal. Just for reference purposes, the average investor out there will achieve 30 to 40% when it comes to accuracy of selections, based on some of the research that we've done and looked at. Here's a look at our month-by-month results. As we said, we're going on 4.5 years. We do have a slight positive relative return. Relative return, again, is the actual results minus a matching investment in the Wilshire 5000, so anything above 0 here would be good. But we really want to get up to that 5 percentage point advantage to the Wilshire 5000, and hopefully even above it over the long term. You can see we got kind of close, and I would argue that the longer term trend is pretty good. We also we're a little bit slow out of the starting blocks, and have recovered pretty handsomely since then, and really do hope to end up at in that greater than 5% relative return range. Our outperformance accuracy has slipped a little bit back down into the mid-40s, as you can see there by that 45.1%. But again, generally satisfied with the trend, and just hope that we keep picking good stocks and pushing that northward. Here's a look at the portfolio. Just spend a couple minutes with it. This is the tracking portfolio. What we do every single month is, if any one of the participants selects a stock or the audience votes for it, we basically take $1,000 and invest it in these companies. You do have to kind of break down the code here. Cognizant Technology right now, if you come down to the bottom of the page, Cognizant has been selected 9 times. Well, that would be $9,000. $9,000 has become $12,300. So you can kind of look down the page. These are the companies that have been selected a few times. These actually have the most impact on our overall results, hence that's why they're here. If you do want to look at the entire portfolio, the link is down at the bottom of the page, and it's also available on the Manifest Investing homepage right on the front page. So you can actually go take a look at the portfolio. Any of the positions surprise you or bring any thoughts to mind, gentlemen, or Susan?
Well, Mark, I know that we've chosen Landauer an awful lot, and it's not even appearing on this front page. We've chosen it 5 times, which means we've put $5,000 in it, but it's not on the page. I know that Landauer has had some real disruptions, and if nothing else, I'd like to maybe talk about Landauer at length at the next roundtable meeting, if we possibly could.
Yeah, let's go ahead and do that. I don't know, Cy and I have both selected that over the last couple of years, and then they certainly have a pretty severe case of indigestion with that acquisition. Cy, do you have any comments on it or thoughts at this time?
Not really, except to echo your indigestion comments, and it's one of those companies that is definitely having some difficulties remaking itself. They were concerned about just the pure radiation testing not being good long term, and so with acquisitions and the like, they've gotten into the medical arena, and it's a little bit harder than they've really anticipated. The biggest thing that's going on with Landauer, besides just the indigestion, is again they're investing big money in revamping their IT systems, both back office and some of the manufacturing, and have high costs associated. If it works, they're probably a pretty high speculative long-term pick. If it doesn't, we'll probably keep seeing them go down. So it's, I think Ken's point to talk about it next month would be good.
I think we should. I mean, go ahead, Ken. I know you'd like to talk about what you see on the screen.
Yeah, my primary concern is this quality line. That's the blue line for those of you that are looking at this graph right now. And when I see a company whose quality has declined as dramatically as this one has in the last maybe year and a quarter, I think that there's really something going on that we need to get to the bottom of, and I know a lot of it has to do with the acquisition and the difficulty that they're having in basically digesting this huge acquisition, but it seems to have spilled over into other parts of their business model as well.
Let's go ahead and make a note and present a case study on it next month, including how we look at what specifically has deteriorated here, what are they saying about the challenge, and make some judgments. The analysts do seem to have they have some optimism that they're coming out of this, at least as evidenced by the return forecast at the 15% level. And of course, with the way that prices dropped, we'd like to see a little bit more than 15 there. But again, it would be a matter of whether we think there's a optimism for recovery. So we'll take a look at that. There's a lot of awfully good stories on here also. I mean, the BioReference Lab stories continues to be a strong one, although it's a very volatile ride for those of you that follow that closely. It's one of the more widely followed companies by people in this area and by Manifest subscribers. So all that stuff is cool. Let's go ahead and switch gears and talk about some of the horses we have ridden. This is more fun than talking about Landauer. What I basically decided to pull up is much like we do for our awards show, just kind of give a mid-year update on what some of the more successful selections have been. It gives you some insight as to how we keep track also. Every single position that we put in, again, as you can see there, whether it comes from one of our 4 knights, a guest damsel or a guest knight, or the audience, is shown there in the ticker column. And you can see that the all-time best selection in terms of relative return contribution came from Hugh, and with Southwest Airlines, ticker symbol LUV. And just reading this from left to right, you can see the period, the date of the meeting where Hugh selected it, the date that it was closed out, and then the average cost. Average cost going from $820 to $1856, so that's a gain. That's an annualized gain over the period of time that it was held, but it's about a year and a half, of 66.6 during a period of time when the stock market actually gained 18.1. So again, you're looking at nearly a 50% relative return on that one, and you can just kind of look down the page and see virtually everybody's got one on here, and pretty widespread display, universal display here in the middle, kind of interesting. That one's been very kind to us this year. And Cy will be bringing Priceline once again down here. Any thoughts on that, guys?
I just saw that Priceline's the only thing that got me on this page, so how could I pass it up tonight?
You got to go for it again.
That's right.
I notice I'm not on that page yet.
It's early for you, Susan. It's early.
I know.
I still love this. I love this concept from Polaris here, Mark. If you don't know very much about Polaris, and I don't think it's a buy right now, but it's really a very, very interesting company. And if you know anything about Harley Davidson, you should know equally as much about Polaris.
Yeah, and I would second that. If you happen to be an individual interested in Polaris, or if, again, could be a stock watcher for Polaris, you can go back to that April 2013 meeting, and Ken gave a fascinating presentation on the company. You can reach back to that at manifestinvesting.com under events and actually go back and look at the recording. We're recording tonight, so we'll make this available in the future also. So there's some good ones on there. I will point out that there was some skepticism of my selections of Apple. I would like to not going to do an I told you so, but there's an awful lot of very friendly Apple entries on there. And it hasn't hurt me a bit this year.
Well, I'd like to see your name on this list for a change here, Mark. It's really good to see your name up here. You know?
He always finds a way, folks. He always finds a way. All right, let's go ahead and press on with our selections for tonight. We're going to start with our guest, Susan, and the company is CaesarStone. It's a fascinating company, and Susan first brought this to us back during our February session this year when we were having our award ceremony, and we discovered that they were using CaesarStone at the Academy Awards at the place they're actually handing out the Oscars. So it's kind of cool then, and it's going to be a bumpy ride, but there's a lot of good indicators. I'll talk more about that when it's my turn here in a few minutes. But go ahead, Susan.
Okay, fine. Thank you. Hello, everyone. And I'm very honored to be here again this evening. This is a second presentation for CaesarStone, as Mark indicated. This piqued my interest again. If I can just have a little personal note here, my son and his wife were looking for a new house this past couple of months. And the comments I heard about when they looked at one house or another was, well, this is fine, but the kitchen. Or, oh, the kitchen is wonderful. Oh, the kitchen. It all had to do with the countertops. So this is what CaesarStone does. It's a, next slide, please. It's a manufacturer of high-quality engineered quartz surfaces, which are used in both residential and commercial buildings. They do countertops, vanities, walls, floors, and other interior surfaces. Come in a variety of colors and styles, and they're known for the quartz is known for hardness, being non-porous, and some other good qualities. Next slide, please. This is a more detailed, some of these slides are from the initial presentation that I did, and I got a lot of these slides from a hint that I learned from Ken Kavula by going right to the company's website, and they very often have presentations, and they have a wealth of information. It's much easier to find facts and figures and predictions and whatever about your company. But anyway, this is where this came from. So this company is a global company. It is based in Israel. However, it sells its product all over the world. In the past, the major consumers of the products were in Australia and the United States. They comprise the biggest consumers. The USA market has been increasing. In 2012, it was 29% of their sales, and now it is 35%. Australia has dropped off a little bit, and they really sell all over the world. Next one, please. In the United States, here are the places that have distribution centers. So they're really spread out both coasts, and they're starting to come into the Midwest also. Next slide. So this again is the slide from their presentation. So they are the global leader in attractive quartz surface market. This company has only been public.
Excuse me, Susan, for just a moment. We're getting quite a bit of background noise, back room folks. Could everybody mute except for Susan right now so that our audience can hear everything? Thank you. Go ahead, Susan.
Okay, thank you. Although this company has only been public for a little bit over 2 years, it's been around for 27 years. So they've been in business a long time. They just have not been a public company for long. They have a very well-known premium brand, and they have 12% of the global market share of quartz countertops. They are now selling in 50 different countries, and the market share now in North America is projected in 2014 to be up to 50%. So what is a quartz countertop? Well, it's a composite. It's a ground up quartz, and it's put in with a resin and then molded, and it's a very hard surface. It has some other good qualities that I'll tell you about later, but its competitors are different kinds of countertop surfaces, one being, and the little graph on the bottom shows kind of a growth curve of countertop types. As we all know, fashions and tastes change, and what the consumer wants and buys. So on the left-hand side is the quartz, little orange circle, and that seems to be on the beginning of the growth curve. It's starting its upward growth and becoming a bigger part of the market share. And on the other end is marble, which is kind of out of favor right now. The other kinds of countertops are solid surface, like corian. Then there are granite and the laminates. The laminates, of course, are the most economical to put in. The other four are really high-end countertops. All right, next slide. This is a little study that was done by Brent & Spa in Italy, not done by CaesarStone itself, showing the attributes that make CaesarStone or quartz surfaces superior to granite, laminate, and solid surfaces. And the biggest one for me when I put in new countertops was the low maintenance. With the other natural stone or granite, you have to seal it every year or you can get a ruined countertop. This is there's no maintenance at all as far as sealing. I mean, you have to clean it, but as far as year-to-year maintenance, there is none. It's you can read all these things, but it's just, it has many more pluses than minuses, even though the price is about the same. Next slide. So the current strategic position, according to the company, is that they are continuing to expand their markets in the United States. They have started selling their products through IKEA in the United States in particular. And I'm not sure what the Consumer Report thing was there. They're also expanding more in Canada and more in Europe. And it's because of the high quality of the product, it can increase your real estate value. You know, a good kitchen adds a lot to your price of your house. So next slide, please. The company is also expanding the manufacturing capabilities that they have. They have, at this point, most of their manufacturing was done in Israel, and then there was the problem or the added expense of shipping the product to the consumer. The 6th and 7th manufacturing lines are now going to be in Georgia. So they will be opening and be up and running, they hope, at the beginning of 2015. It has a very strong financial profile. They have a strong balance sheet. They have low debt, and the management team has been around for most of the life of the company. Next slide, please. So this is a little chart that shows what the U.S. countertop materials are, what they make countertops in and sell in the United States. This is by the volume, not by the price. So quartz is at 6%, which hopefully then will have room to grow. Laminate, of course, is the best seller because it is the cheapest. But high-end homes and whatever, you'll see more natural stone, quartz, and solid surfaces. Next slide. So where do you get your solid surface or your countertops? Well, you get from mass merchants like the big box stores, or the commercial, institutional home builders, whatever, or the retail outlets, the kitchen, bath, showrooms, the places where you go for design help. Next slide, please. CaesarStone sells to whoever will buy, I guess, but the 30% of their sales is for new dwellings, and 55% goes into remodeling, which I think is real important in this economy, that more people may be willing to spend money on, I wouldn't say not necessarily a small project, but putting a new countertop in is certainly less expensive than upgrading to a new home. And then 15% to commercial, meaning the total market then of 100%. Next slide, please. This, I think, is a very interesting slide. This one came off the new presentation on the company's website. And this is from the National Association of Home Builders, and the chart shows the annual building permits and how they just really dropped into nowhere in the Great Recession, and how they are coming back slowly. I mean, if you look carefully, it is an upward trend. It's not growing real fast, but it is on the upswing. Next slide, please. Also very interesting is the private residential improvements, and I presume this is remodeling. So there's your average and your actual spending. Again, the big drop-off in the big recession, and, or excuse me, the Great Recession, and that seems to be picking up also. This is a good sign for companies like CaesarStone. Next slide. So where do all these pieces of countertop come from for CaesarStone? Well, if you'll notice, the first five are SY, SY, BL, BL, BL. Those are all companies in, or those are all places in Israel. And the 6 and 7 are the ones being built right now in the United States and Georgia, and number 8 and 9 are to be determined. So they are getting another presence in the United States. Shipping costs will be less, and hopefully they'll sell more product. Next slide. This shows the growth rates since the company has been public and another year before. You see all the lines are straight up. 20% growth, 25%. It's just looks great. The pre-tax profit, net profit margin is up to 17%. Revenue growth rate is 21%. Company just seems to be doing very well on paper here. All right, next slide, please. This also was on their presentation. I thought this was kind of germane. Predictions are extremely difficult, especially of the future. And I thought this would be like a Yogi Berra kind of quote, but it's from Niels Bohr, who is a physicist. You should know him, Mark. Next slide, please. Predictions are very difficult for this company, and we'll talk a little bit about why that is after we go through some of these other slides. Here's the eagle from Manifest Investing, and it looks very promising. You have a par of 22.6, which is a little bit of nosebleed for me. I usually don't like things in the yellow. I like them in the green, but as I look down here, the net profit margin, he used 17.8, which I think was fine. The growth rate of, did you have a growth rate on here of 18? Growth forecast sales, I was fine with that. Thought the average PE ratio was a little rich for the company, but we'll talk about that later. But anyway, it looks good on paper. Also, the CAPS rating is 5 stars, 5 gold stars. So far, so good. Next slide, please. This is where I find it a little difficult, and that is when you look at the SSG, everything looks great until the last 2 quarters. Sales growth for 3 years was up 20%, 2 years up 17%. Earnings growth, the same periods, 19 and 30%. The debt to capital is still low, but for the last quarter, most current quarter, the sales were up 30%, but earnings were down 8.4%. Return on equity was still good for 2013 at 27.6, which is excellent. Next slide, please. Oh, then, excuse me, go back to that. Yes. So for a growth rate for this company, I chose 18. And the reason I chose 18 is I actually just lifted it right from the company's guidance, and that's what they say they might be doing in the next year. So I just used that. All right, next slide. Here you'll see with the difficulty with the PEs in the section 3 part. We have PEs of 14 and 29 for the high and 8 and 9 for the low, and currently of 27.9. There really aren't enough numbers here to really make a good judgment on averages or anything else. So it's really kind of a shot in the dark. So what I did is I just took the used the future high price, future high PE of 29 being the one from 2013, and the low one I chose 18, which was my growth rate on the front of the SSG. So doing the math, next slide please. It comes out to be a buy 3.9 to 1, and with a projected average return of 14%. So I'm perfectly happy with 14% average return. That's great, and even the compound return of 18.9. So a little less than Manifest did, but I'm still happy with that. So next slide, please. So now that we've done all that, I did look at the analyst estimates from Yahoo, and the sales growth there was 23.9 for next year and 19.7 for the year after. So I'm still comfortable with that 18% that I chose for the growth rate. Next slide, please. This particular slide of the last grouping there shows the growth estimates for earnings, and those again are all in the high 20s, so 18 is a little conservative, but that's all right. I'm happy with conservative. Next slide. Oh, I also wanted to point out that, excuse me, can you go back?
No
that
problem.
Yeah, okay, that the earnings trends, the estimates had actually increased Not a whole lot, but they have increased, and that's a more hopeful sign. You don't like to see those go down. Up is better. All right, now next slide. So while we're dithering around with growth rates, this is a chart that shows what would happen if you had bought the stock when it first became public and held it, and wouldn't that have been nice? However, we're not there. We're 2.5 years later. So next slide, please. And this one is out about a year.
About a year.
A year, okay. Shows a little volatility with this stock. So we should probably talk about why it is so volatile. We like the growth rate. We like the results we're getting for our return, but you know, these bouncing around, there must be a reason for it. Well, Mark mentioned that we had this for our February roundtable, but it was actually March 1st. So if you put your little cursor there in March, yeah, and you'll see that the price at that time was pretty high. It was getting up there. It did go up a little more. And then it reported earnings at the beginning of May, and it went up a little more. Oh, excuse me, at the beginning of May, and it actually had sales had grown 23.5%, and earnings were up 24.6%, but alas and alack, it did not meet analysts' expectations. So the price dropped a little bit at the beginning of May. Then we move on to June. Well, it's still going down, down, down. What is happening? Well, two things happened. One is that this particular stock is, the company's small. It sells only about $350 million in sales a year, so it has so very few shares, but those shares, 70% of those were held by the kibbutz in Israel, the Saddam Yam kibbutz. Well, long about the end of May, they decided they were going to sell some shares, so they sold off $23 million they sold off 21% of their holdings. Well, the market didn't like that very much and got a little nervous, but they really only sold, well, 21% I guess is a pretty good percent, but they didn't completely dump the company. So that's what happened. Also, right about that same time, there was a class action suit filed about independent fabricators contracting silicosis, bad lung disease from working with dust of granite. And the analysts at Motley Fool, Brendan Matthews, said there's certainly a risk with the stock with the suit, but he wasn't willing to make any short-term predictions as to who would win the suit. He says that CaesarStone plans to defend itself vigorously. So since then, now we move on to the end of in August. What happened in August? All of a sudden the price zooped right up again. Well, we had another earnings came out, and the sales were up 30%, and the earnings per share were down 8%. Well, the market thought that was good, I guess. It went right up. Also, they did think it was good because of, first of all, they said that the earnings were down because they were impacted by foreign currency exchange fluctuations, and some non-recurring charges. Also, their predictions of what's going to happen, their guidance into the future was still for a growth rate in the over 20% coming into for the rest of the fiscal year. So the price went up. However, since then it's just been flat, 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 flat. It's been between 51 and 52 for about a month and a half. Next slide, please. Well, this shows the same thing in a little more detail, and it shows the at the top the RSI, which is down to 50, which is probably a very attractive area to maybe think about buying. I think that perhaps the stock may just take off for us nicely. And earnings come out again in November, and if they are good, maybe we'll get another spike in there. All right, next slide, please. Now we've talked about the graph and whatever, and here's a list of the cons and the risks. I talked about it having only 2 years of public history. It's very thinly traded. Not many shares trade every day. Analysts, there are only 6 analysts covering it. There is one company that supplies 55% of their raw material, and they're from, I think it's Turkey. The building industry recovery could be pretty fragile. I don't know if it's going to continue or not. I hope so. Fickleness of the consumer, taste change. Don't know what's going to be in next year or the year after. I just talked about the class action suit, and also the headquarters are in Israel. There's been a lot of turmoil, as we know, in that area, Syria, Israel, whatever. So hotspot, maybe it won't be so much of a problem once they start producing more in the United States. Next slide, please. Yeah, on the positive side, the housing market is more active, and high-end countertops are very desirable. They have worldwide sales. The growth rates are wonderful, and the return on equity is good. Analyst estimates are attractive, and it looks like it's a good buy at this point. So that's my presentation.
Good stuff. Thanks, Susan. Yeah, it's a good update. We'll make that as a repeat selection into the portfolio, and again, I think it's... Go ahead.
Susan,
Ken.
we have a question from Nancy. She'd like to know, is CaesarStone an ADR?
I own it. I don't know if it is or not. I would think it would have to be if it's an Israeli company. It does not pay a dividend, so I really haven't had to pay much attention to whether it's an ADR or not.
Okay, and a question from Rita. Did you find information on CaesarStone in Value Line?
It is just in the expanded version, so there's no analyst opinion on it, but yes, there is an abbreviated one.
Okay, thank you.
Anything else at this time, Ken?
No, we're pretty up to date, Mark.
Okay, we can always come back if somebody has more questions about it. I'm pretty sure it's an ADR, but we will confirm that and add it to the notes for the session. So let's go ahead and go with your selection, Ken, Cyberonics.
Okay, Mark, if you could switch to my screen.
Sorry, taking me a second here. You should have it, Ken.
Okay, I think I do here. Let me get the show playing. Okay, I'm going to be talking about a medium-sized company called Cyberonics. It's the leader in medical devices for epilepsy. You can see that it does most of its business here in the U.S. Over 80% of its business is in the United States, but it does have a 20% approximately presence internationally as well. It's a Houston, Texas company, about 650 employees. And it's implanted about 115,000 devices, and they've so far accumulated about 580,000 patient years. It's a relatively new technology for dealing with epilepsy. The technology is called vagus nerve stimulation, VNS for short, and basically it's stimulating with mild electrical pulses the vagus nerve, which is in the neck. And that nerve is then sending signals to the brain. The pulsing is adjustable. It can also be made automatic or intermittent. It's actually implanted sort of like a pacemaker So you have the device somewhere in your chest, above your heart in your chest muscle, and then you have a lead that goes through your neck near the vagus nerve and moves up towards the brain. Cyberonics manufactures the device and the leads both. The procedure is done in an outpatient laboratory under general anesthesia. Two small incisions. You can see an example of the neck incision. It's not anything that's particularly large, but it is invasive, and you do have these things implanted in your body, much like a pacemaker. You can then do the dosing with a handheld computer and wand, and you can increase, decrease, change the length between dosages. You can do a number of things with this small computer, and the doctor helps you set the controls on this VNS therapy system. There's a meaningful economic proposition to the whole concept of this VNS therapy. There's a simple graph in the lower left here that's showing that medical costs for a typical epileptic patient, it actually costs as much as $10,000 to control epilepsy, but within 18 months, if the VNS therapy is successful, you move from the patient costing money for his treatment to there actually being projected savings. There's also rising Medicare reimbursement averages for the different devices, and as the devices become more well known by physicians and more well known by patients, we're anticipating stronger and stronger growth rates in the VNS system. Actually, Cyberonics indicates that most of their growth is driven by product development. Here's 4 of the older products that VNS or that Cyberonics has developed, and these 4 older products generated 85% of the revenues since 2008. They do have 22 product-related FDA approvals that have already happened, and at this point they have 119 patents in the United States and 169 globally. Here's some newer devices. An extra 167 U.S. patents, 267 global patents, and these will lead to new product submissions which should help Cyberonics continue its history of pretty consistent growth. Cyberonics is basically dealing with most of its business in the epilepsy field, but they're also doing a lot of work in chronic heart failure. In fact, on September 1st of this month, they just had their autonomic regulation therapy passed its first trial, and those results were released, and in fact the device seemed to be doing exactly what it was supposed to do. That's in contrast to a device from Boston Scientific that failed in its initial clinical trials. They're also moving into obstructive sleep apnea with some different products, into treatment-resistant depression, and they're always open to other fields of study. In addition to their VNS therapy, they're also working on some external vagus nerve stimulation devices, and they're also looking at some different types of products that will deliver some of the same benefits of the VNS therapy in different ways. So internally and externally, Cyberonics is moving into different fields to widen its product line and to deal with more steady growth going forward. Just to summarize everything, epilepsy is the 4th most common neurological disorder. And despite numerous types of treatment, about 30% of patients continue to experience seizures. A VNS therapy system is a foundational treatment. That means it's a treatment that has the ability to greatly improve the number and length of seizures and therefore the quality of life. Cyberonics is also moving into other fields besides epilepsy. Here's a chart from the bottom of the Manifest Investing sheet on Cyberonics, and here's what drew me to this company in the first place. Again, I'd like you to focus just on that blue line, if you would. That blue line is the quality of the company, and you can see that since maybe August of 2010, this company, which carried a quality rating below 40 at that point, has moved to a quality rating near 100 with a nice, mostly steady upward swing in that quality rating. Every time you see a step up, you can pretty well assume that there's been a significant change in at least one of the 4 quality measures that Manifest uses. That might be net profit margins as compared to the industry. It might be sales growth as compared to the industry. It could be earnings stability, or it could be financial strength. But to move from somewhere around 40 to somewhere near 100 in this period of about 3.5, 4 years means that we have a company that's greatly improved many of its metrics. I'm looking at the sheet up here, and I basically agree with most of the judgments that were made on the equity analysis guide. Mark calls this an eagle. I especially focus a lot on the PE, the average PE ratio, and Mark has given this company an average PE ratio of about 25. That really helps guide me an awful lot when I'm preparing my stock selection guide. I also like the sales growth rate of about 11%, and that in fact is the sales growth rate that I used when I submitted the company to preferred procedure. The company is covered by Value Line. Its most recent timeliness is 3, so it's gone up 1 notch since the actual printed page. You might want to read these 2 paragraphs in the corner. These are the 2 concluding paragraphs for Cyberonics, and they both seem very, very positive for the long run. I'm looking at annual rates for sales growth at 13. Remember, I've decided 11 is a great number. And earnings growth, Value Line is suggesting, might be as high as 15.5. At a price of $59, Value Line suggested that the low total return would be about 8%. Recently, the company's been trading at around $52. That's more than a 10% decline from this 59. So I would expect that this low projected number would move up to maybe 10, maybe even 11% as far as Value Line was concerned. I'm going to move real quickly to an SSG for Cyberonics, and its ticker is CYBX, and I bring it up right here, and I like to make the comment that probably I would eliminate these first 4 or 5, maybe even the first 6 years, and focus on what's been going on since 2010. If you'd like to focus on the behavior since the Great Recession, I think you'll see that the trend line for earnings and the trend line for sales lies pretty close to the data when you do that. I've chosen 11% growth rates. Here are the analyst numbers going forward, which certainly are within my judgments for growth going forward. When I turn the SSG over, I like what's happening on margin. I like what's happening on a return on equity. I like what's happening on debt. For the last 3 years, I've seen some clustering of the PE values, and I've moved to a 30 and a 20 going forward. When I checked with Mark's Eagle, I found he had used an average of 25, exactly the same average that I have right here. I've adjusted, and I'm getting about a 12% par value. That's very close to what Mark suggested the potential should be. So all in all, I don't find too much not to like about this particular SSG with Cyberonics. So I'm going to suggest we take a small position in Cyberonics for the roundtable portfolio. Mark?
Thanks, Ken. You want to go ahead and switch control back to me. Not spotting any questions. We can field questions here in a few minutes. We're going to have some time. It looks like there might be a couple of questions here. We will take a look at these after we get done. Do I need to make the switch, Ken, or can you do it?
I can do it for you, Mark. Here it comes. Maybe here it comes.
Could be lumpy electricity.
It probably is lumpy electricity. I don't understand why it doesn't want to hold right there for me. Mark, you're going to have to do it yourself, okay?
Okay. It might have been the side door I came in.
There we go. I got it. There we go. Okay, and it's back to you. We do have a hand in the air, and it's Joan Clark. So, Joan, I'm going to unmute you real quickly. Go ahead.
How do you feel about the CAPS rating of 2 for Cyberonics?
Oh, I know this might be heresy, Joan, but I don't really follow what's happening at the Motley Fool. I don't have a lot of faith in that that large community. I don't think it's telling me too much. So I don't feel one way or the other about it because I don't follow it.
Fair enough.
Okay?
Yeah, I guess the only thing I would add to that is, that's basically suggesting that there's at least a body of people out there that have some inhibitions or something about the company, and it could lead to some swimming upstream. I typically use that type of information as part of a tiebreaker batch, if you want to think of it that way. Okay, we could probably catch any other comments after we go to Q&A, Ken. Is that okay with you?
Sounds good, Mark.
All right, with that, we're going to go to one of our favorite Atlanta Braves, Cy Lynch, and his repeat selection of Priceline.
All right, thank you, Mark. And I'll go ahead and start with Priceline. I guess I'll start at the end and then go back to the beginning. Ken showed you the value line for Cyberonics, the 4.3 rating and the comments, and actually Priceline's value line looks very similar. It was a 4.3, has just been upgraded to a 3.3, and they tended to say the same thing. Unfavorable year ahead based on price, but favorable long-term prospects. So that's one thing that attracted me to Priceline. You can see here pretty much as up straight and pretty close to parallel as you can get between the sales and earnings line. So certainly a good potential candidate to take a look at. Next slide, and I'll show you exactly where it came from this month. This is the roundtable dashboard, and ranked by par, and you can see the top holdings that were here. And I just started running my eye down. New Star, which was one of my picks, they're in a very questionable area right now. They're rather speculative, so I did not choose to go with them. Solar Winds, notice the 20% financial strength. I liked the price line with the 97 strength and the 96 quality to go with it, so that certainly looked attractive. I just kept running down the list, and notice I've highlighted the financial strength and quality on Cognizant. So it was kind of a bit of a toss-up between the two, but to keep from getting booted by being repetitious and sticking with Cognizant, I said I'll be a little variety this month, and we'll go with Priceline. And I think there's certainly some potential attraction of it even over Cognizant. It's something a little different. So that's where I came up with it this month. Next slide. And these are the judgments. This is my personalized EAGLE, or Equity Analysis Guide, from in the Manifest Investing format. You can, of course, find this under the My Stock Studies area of the website. I chose a 20% sales growth rate. You can see the 3 judgments that I've circled that are the key judgments that you have to make. That's a little below the value line and the Manifest growth rate of, I believe, 21.6 or so is what Manifest was running, but roughly in line. I almost changed that to 19.99 because I just have a particular aversion to 20%. But I won't get into that tonight. I've just heard 20% is conservative too many times. But anyhow, 20% is the number that I arrived at for this company. Net margin of 27, which is a little below the current margin, but roughly in line where it's been the last 2 years. Most analysts, Value Line, Morningstar included, anticipate the margin to continue to expand. Manifest does as well. I've chosen to leave it about the same because it's had tremendous run-up in the margin, and I would prefer to be pleasantly surprised. But I certainly think some margin expansion is possible. They are issuing shares somewhat for compensation and acquisition purchases, and that's reflected in the share judgment. That's not circled, but that is a judgment that you make. And then that led to my $86.28 price earnings per share. And the average PE I chose of 25, which again I think it's just slightly below Manifest, which I believe is 27 if I recall, but it's about the same, and that gives me a projected annual return or a par of 13.2%, which I thought is very healthy. Another thing that attracted me to this company, Mark, by any chance, can you jump over to the Eagle? I mean, not the Eagle, the Chronicle.
Sure, we can do that. Just give me a second to catch up. Priceline.
Sure.
You want to look at the Chronicle?
Right down
Okay.
here, and you can see here if you look at the red line that is trading. That is the par for the company. You see that it is currently at almost an all-time high based on the 4 years of history that you see, and you can of course see back in August or so of 2011 how much the price has run up since it was in that time frame, and so that attracts me to it from a price standpoint a little bit, but also I like the fact that you can see a little bit prior to that August of 2011, notice the price is relatively flat, but the fundamentals were going up as reflected by the quality and the increased par. You did see a price run up over the next several months after the August 2011, and then there in it looks like February or so, the price got up, then it pulled back a bit and kind of stayed flat really for looks like about a year before it started back up again, and then again it's been flat to down for most of 2014. Again, one of the big things that I really like to see in a company is little price movement yet continued fundamental increase, and you saw the earnings and sales growth lines on the front of the SSG going up, while as we can see, it looks like the company price has been resting perhaps a little bit, and we're ready for possibly another breakout, certainly in the next year or so, if not sooner than that. So that was another thing. That's about the closest you're going to get me to technical analysis. I think it's a mix of fundamentals and technicals. But I do like seeing some flat price with increased fundamentals. That tends to indicate to me that there's potential positive price movement ahead. So since Hugh's not here tonight, I thought that I would say we need more Kirk and less Spock tonight, and recommend Priceline, or choose Priceline for the roundtable portfolio.
Sneaking William Shatner into the mix.
There you go.
Cy, I just wanted to let you know that Priceline was my runner-up for tonight, and I just would like to remind everybody out in the audience that those of you that think that Priceline is just that website, Priceline.com, you need to go and take a real close look at the company, because it's a whole slew of websites. Many companies that you don't even relate to Priceline are actually owned by Priceline.
Yes, very, very good point. In fact, I believe Booking.com is about 60% of revenue. And, of course, there's a bunch of others as well.
Cool. Well, thanks, Cy. And that one has been pretty kind to us, and it actually does show up on my screening results for tonight, too. So I'd have
Great minds think alike.
All right, let's go ahead and I'll wrap up. I show 9:30. We typically try to keep these to 75 minutes or less, so that gives me a few minutes here to work with. Put together what I'm probably going to use for the Sweet 16 for our October newsletter this afternoon, and it's just kind of me kicking around a little bit. What I did is I basically went out and grabbed the companies that all have pretty good projected annual returns along with quality ratings. So in other words, the long-term outlook for these companies is all pretty good, and I used the combination of those two, the manifest rank, and we're looking at just the top, I believe 5, maybe 7% of all companies when I do that. And then I threw a little wrinkle at it. And it has to do with this notion that I think most of us, if not all of us, believe that price does follow earnings eventually. And what I was looking for here was, I don't want to do the technical analysis stuff either tonight. It gives me a headache. I don't want to, I just want to think in terms of an instinct or an intuition that we have, and then go and see if I can find something to act on that, and perhaps even use it as a screening criteria. And that's what you see here. What I've basically done is I'm looking at the 2015 earnings estimates for all of these companies versus the projections for the end of this year, and I'm comparing year over year. So in other words, I'm looking for the companies that have a projected or an expected uptick in their earnings trend in the next year, thinking that perhaps it might make some sense to combine that. You can throw all that other sentiment stuff off to the side. If we really believe that earnings, or the stock price eventually follows earnings, these could be potential opportunities with perhaps a little bit of afterburner. And so basically what you see here, so these are sorted by again, that 2015 earnings estimate over the 2014 estimate. And Atwood Oceanics came up at the top. I like a bunch of these up near the top. Google, Size Priceline, Neogen makes this list. Lumber Liquidators. Notice the number of building material companies. Well, there's one there, but there's a bunch of them just off the list. There's just a bunch of those type of companies like Susan presented, that seem to be in position for an earnings kick. And just something to keep in mind. I really like the notion of investing in Tupperware, believe it or not. I don't have any particular history with the company other than they are organizing my cabinets here lately. Again, just the notion of a pretty good, solid long-term company. If you're out there and you're looking, let's say you have maybe a little bit more overall growth in your portfolio and can afford to have a slightly slower growth company at 5%, maybe Tupperware is right. But for what we're doing here tonight, I think I'm going to go ahead and go with the very first selection on here, Atwood Oceanics.
Mark, we're getting a lot of questions about these asterisks on the list. Can you just real quickly tell them again what that means?
Yep, all the asterisks means is that it's not in the value line standard edition. So it's from outside that universe of about 1,700 companies. So that's all that means. You heard the question with CaesarStone. It's in the small and mid-cap edition. So is Atwood Oceanics. So is Neogen. So and so is Portfolio Recovery, which happens to be our 19th most widely followed company. Any other questions on this particular screening result, Ken?
No, we're in good shape.
Okay. So I'm going to, normally I try to tiptoe down the list. I did feature Aaron's as the featured stock in last month's newsletter, and it is a story worth visiting. If I couldn't come to grips with Atwood or Tupperware, I'd probably be most willing to go into Aaron's again. I'd encourage you to take a look at that story. But let's talk about Atwood for a second. It is in drilling and exploration, development of oil and gas resources. They currently have about, I don't know, I think it's 13 different rigs, but they are under contract to build another 88 rigs between now and the year 2020. A potential downside that I could see is that approximately 30% of their business does go to Petrobras in Brazil. So they basically put these dudes together, the rigs, and in many cases they're actually flotation boats, great big boats that have drilling apparatus and literally fields on these boats. And they are recognized as an industry leader in that field. Again, it's an area that's going to be a little bit dicey, sometimes a lot dicey, depending on economic conditions. But if you're of the mindset, I wish I could snap my fingers and make all the coal and all of those dirty fuels go away. But the fact of the matter is they're not going to go away overnight. They're probably not going to go away in many of our lifetimes. And the companies that are out there reliably retrieving, hopefully as safely as possible, are going to continue to be in vogue. Schlumberger is another name that we toss around. I'm certain that Schlumberger works with these guys. You can see fairly interesting trends here. Again, there's going to be some economic bumpiness to these to the business model for this company, but pretty much up straight in parallel. A little bit of profitability drift on the right-hand side of that picture, and we'll take a closer look at that. Here's a look at the sales and earnings from 2007 out to the current estimates for 2014 and 2015. Again, fairly decent overall trends with some expected bumpiness. And again, this is what we screen for here. These the picture that you see on the right-hand side here with the two arrows. We're screening for this condition of an upward bump, 2015 over 2014. So that's what you're seeing visually. That's what we were looking for with that first column in the screening results. So again, all of the companies that are on that list will fit this in this type of picture in some way. Here's a look at the profitability for Atwood Oceanics over time. You can see there's a little bit of compression downward. Again, seconding the Ken Kavula's suggestion of go to the investor relations. If you go to atwd.com, that's Atwood's corporate site. Click in under Investor Relations and click down to Presentations. They recently made a presentation at a Barclays Investment Conference just a few weeks ago. And one of the slides there talked about their position. One of the things I like about this slide is it identifies who they think their competitors are, from Seadrill to ESCO to Diamond Offshore. That's Transocean, Rowan. You see who the competitors are and where they operate in relative terms on the profitability scale. Again, that's going to be net margin. And you can see the average company in this industry cranks in around 20%. Atwood has always commanded a premium to that, but you can see that the trends here over the last several years have been down. Again, perhaps as they grow, perhaps as the competition in the oil and gas field continues to escalate, it might be natural for this company to continue to see slightly lower percent net margins in the future. So that could be part of any study. Again, I would be comfortable operating in the 25 to 30% time frame longer term. Along with that compression, again, growth is going to slow down as they get a little bit bigger too, but a little bit of a slowdown in growth and a maturing of profit margins is probably going to deliver a compression of the PE ratio over time, a natural compression. And you can see that we're talking high single-digit PEs for this company just based on this picture. And a fairly sharp reduction expected for 2015. Here's a look at the equity analysis page that's actually a prototype. You know, many of you have been following this. We're looking at embedding the My Studies or user inputs, however you want to think of it, right on the company report pages. It's something that we're working on in development, and it'll be interesting to see how this unfolds. What I've done here, and again, you know, you've heard all of the presenters here refer to the manifest estimates. Keep in mind that the manifest estimates for virtually any characteristic are a consensus or a composite of many sources, including Value Line, Morningstar, Standard & Poor's, and perhaps even a couple others. And so anytime you see the numbers, these do represent literally as if a room full of analysts from all over the place, analyst consensus, truly, sat down and did a stock selection guide. What would they be using? So again, in the case of Atwood Oceanics, the current sales are just short of 1.2 billion. Growth forecast just a little bit under 16%. A net margin of 33.8. You see the outstanding shares, and again, based on those assumptions, an earnings forecast of 12.83 5 years from today. A PE ratio of 8. Again, that's a consensus PE based on inputs from Value Line, Morningstar, Standard & Poor's, a couple other things that we look at. And that leads to a future price of $103, or there is no dividend, so that is all annualized appreciation of about 16%. If you basically take and subjected that to some of the stuff we were just looking at, saying, well, what if some of this stuff really does start to cool down? I plugged in a trailing 12 months earnings that doesn't count the current quarter. Current quarter just closed, so this is actually an old number, but I stuck with it. So it's a stale number, being a little bit conservative there. The sales growth forecast seems pretty reasonable to me. They've locked in the sales for quite some time to come with those contracts over the next several years, but 15%. You could even drop the net margin below 30, but I left it at 30. And again, this is kind of a sensitivity analysis, kind of a what if. Under these set of assumptions, the earnings 5 years out would be closer to $10, and the projected average price closer to 80. So basically a little bit of a worst case estimate. Again, that top number is stale, so it's probably a little bit low, but again, a double-digit return. Right now we're looking at a median return in the market of about 7%, so that still qualifies as something fairly attractive. And again, looking across the entire oil and gas / energy sector, we see some interesting opportunities. One of Cy's favorite ETFs goes by the ticker symbol IEZ. That's been very good to us and continues to be attractive in one of our model portfolios. Just gives some indication that when you look at all the ETFs that cover that area, they all look pretty strong, and this is probably a decent area to be involved with long term, with the obvious admission that it's going to be bumpy at times. It's going to be economically sensitive. If something happens nasty down there in Brazil, this company could have some real stress put on it, but I'm going to go ahead and add it to the portfolio tonight. It's been a company I've tracked for some time, and it is a leader in its industry. It's among its leaders, and we'll add Atwood Oceanics to the tracking portfolio tonight.
Mark, here comes our poll. And this is where the audience gets a chance to choose what they think they might like to add to the portfolio. So feel free to take your cursor and choose one of these 4 companies, or if you don't like any of them, choose none of the above. We'll hold the poll open until maybe 80 or 90% of our audience has voted.
I got to say, I'd be happy with any of the 4 based on what I've seen, and
we're up to 82%. Let's give it about 6 or 7 more seconds. That pushed us up to 91%, so I'm going to close the poll.
Don't cut Susan off. She was agreeing with me.
Oh, all right. And I'm going to share the results.
I'm just too good to you.
And here are the results.
Let the record reflect the first vote was cast for Priceline.
It was. I was right. The very Priceline got out to 100% lead real quick.
What,
Okay.
he's operating a machine on the side?
So we will add a second position in Cyberonics and label it audience pick, and we'll track that right along with all the tracking that we do, and we'll see how well it does going forward. Mark, I'm going to close the poll, and it should come right back to you now. Let's see how that's what I do.
We'll stick around and take questions, but one of the things I did want to make a point to close out the night by pointing out that we are going to have a number of opportunities. If you want to be marking your calendars for future dates, there's all of the roundtables for the last quarter of the year on there. I'll be over in Lansing, Michigan in about a week. By the way, that's the estimated due date for my grandson. So good thing that Lansing's right in the area. Ken and I are going to be down in Dallas on day after Halloween, so that should be fun to hunt Texas. And then we are going to be out. Hugh McManus and I will both be in Seattle mid-November, so we'll add a few more dates.
The Dallas Education Day is actually Saturday, November 1st. If you're jotting down on your calendar, it's not on Halloween. That's when we'll be in Dallas, but it will be on Saturday, November 1st.
Thanks, Ken. We'll make that correction right here on the fly. It's actually on November 1st, isn't it?
Right,
Yeah.
And hopefully all the Ebola will be gone by then.
Hope so.
And notice, folks, we've set a November roundtable and a December roundtable date. If you'd like to be reminded about those dates, just drop an email to my wife at nkavula1@comcast.net. She'll add you to the reminder list, and you'll get a very short email before the roundtable comes up, just reminding you that it is coming up. So if you want to register, you can do that. We'd like to thank everybody for coming this evening. We will stick around for some more questions and discussion after we officially close the session. I'd like to especially thank Susan Michelik for filling in on very short notice. Susan, we will not stop calling you, so be prepared, okay? And
a little more than 30 hours before would be nice.
We'd love to give you a little bit more time next time. Cy, it's great to have you back. I know you've been working real hard at your schooling, but every time you can take some time to join us at the roundtable, it's greatly appreciated. And of course, Mark, I don't think we could do this without you, so thank you again for all that you do for Mid-Michigan. We appreciate it.
You're most welcome. Thanks, Susan, and thanks, Cy.